Welcome to Budget with Upstox. I'm Monika Halan, and this is a pre-budget series where we decode budget 2024 and issues which are both macro and micro. This time, we are looking at the impact of budgets on markets, stocks, bonds, and real estate. Both stock and bond markets look at budget proposals very closely. The bond markets look at numbers like the government's borrowing program. If governments borrow too much, bond prices fall and interest rates rise. The stock markets look for announcements on growth and taxation. They don't like too much redistribution, and higher taxation on assets is a big dampener on stock prices. Today, we will unpack some of these issues, look at the cues that past budgets have given on the impact of announcements on markets. To discuss these issues, I have the most perfect panel. I have with me Mr. Ajay Bagga. Ajay is a financial sector veteran who's currently the chairman of Elements Platforms. He was the youngest CEO of a mutual fund as head of Kotak and Lotus Mutual Fund and has worked across the financial sector with all the best names globally. He now serves on various boards and runs a popular show on Z called AB of Global Markets. I personally find his tweets on the issue very insightful and useful. Lesser known fact is that he is the trustee of the Sri Sri Ravi Shankar Trust. I have with me Deepa Rath. Deepa is the MD and CEO Axis Trustee Company. She is a senior banker with more than 20 years of banking behind her and is today on various SEBI committees. She was earlier a part of the founding leadership team and spearheaded TREADS, which has been a pioneering initiative in the space of digital and transparent financing of the MSMEs. Next, I have Deepak Shenoy. He's the founder and CEO Capital Mind Financial Services. Deepak is a fund manager who's really popular on social media for all the right reasons. He is a voice of reason, maturity, and caution. Deepak was one of the first people in India to start an algorithmic trading firm back in 2009 and now runs a PMS with an application for a mutual fund pending with the regulator. Thank you all very much for joining me today. I'm going to kick open this discussion with opening statements from each of you. We know how bond and stock markets specifically wait for the budgets to see whether it is appreciated or not. So Ajay, I want to just start with you that what have been some of the big disappointments in the past, very briefly. So we know that markets react, we'll come to that. But in the past, few years, what have been some of the major disappointments for both bond and stock markets?
Yeah, I think for the stock market, it was clearly bringing in capital gains tax, because when Chidambaram brought in STT, that was with a promise on the floor of the parliament that we are charging you STT and you are not paying capital gains. So to have both those taxes come in, and if you remember when that came in, the market did react. That I remember as one big disappointment. And STT is very lucrative. At source, you are making 30,000 crores now. It's a very clean tax that you just get. It's like when you fill petrol and that Pradhan Mantri Sadak Yojana charges you 2 rupees cess without you knowing it, and it gets deposited every day in the treasury. It's a neat, clean tax. Capital gains is a messy tax, and then there are all kinds of manipulations that come in. Normally doesn't work.
So big disappointment was that, Deepak?
So I think, Monika, here that the disappointments, of course, from the stock and bond market point of view, stock market point of view was capital gains, like he said. But I think incrementally we've seen a lot more things also come in which are negative, perhaps. Maybe like, for instance, dividends weren't taxed. On a subsequent year, dividends were. There was a choice to be made. So if you wanted dividends not to be taxed, you had to pay a higher corporate tax, otherwise a lower one. There is also the structure of the way taxation works on mutual funds, which has become regressive in terms of debt mutual funds first being taxed from 1 year to 3 years, and then now not taxed at all. I mean, there's no capital gains at all, no long-term capital gains at all. In a sense, changing the tax regime to make it more complicated. So depending on whether you're investing in real estate, private companies, gold, debt mutual funds, equity mutual funds, or stocks, your taxation structures change dramatically. So I think these disappointments for stock and bond, mutual fund markets have happened. The bond markets react more towards perhaps the principle of government-led inflation or government-led deficits, because more the deficits are, the less there is left for other players to borrow.
Right. So that's one number we should be looking out for. Deepa, any major
I
things you
think
can remember?
Pretty much covered both of these, but however, I feel this is going to be a very balanced, budget that's going to come up, given that the dynamics that has come in is much different than the earlier governments. So not much to add from the gentleman out here, but I guess looking forward to the new one.
So what we are hearing this budget is that there is fiscal space with the government to do a little bit on cutting taxes. And there is also this worry that consumption is slowing down. So consumption needs a boost. My hypothesis is that even if there is more money left in the household, in the pocket of the household, what if it goes to repaying debt? Because we are seeing retail debt levels rising. So in context of there being, one is that, is the premise right that we will see a reduction in income tax for some levels? Second, markets are expecting this to boost consumption. So specifically in the context of especially stock markets, maybe we just start with you. One is that if this tax relaxation comes and it goes not to boost consumption but to repay debt, what happens to market expectations? Complicated a little bit, but...
Yes, I think, but you're right. But I think here the problem is the dynamic of the, demographic that is actually borrowing a lot of money is probably people who are not paying tax. In the sense they're less than the 7 lakh per year earning number, and they're relatively a larger portion of the people who are taking on unsecured debt or this higher cost debt, if you may. The low cost debt is not easily repaid because it's usually against housing or something like that. So the people who benefit from income tax cuts, and I specifically say that because income tax is a direct tax, and direct tax cuts will affect people who have the propensity to spend. They have demonstrated that they can, because look at tourism now, look at our traffic, look at our air, the fact that you can't get air tickets anywhere. This is the class that is willing to spend. So if you give them more headroom by reducing the taxation at the maybe the higher levels, you will see some more of that expenditure happen. However, I would say it may not happen immediately. It may take some time, and the biggest expenditure on tax in India is actually GST, not income taxes.
Right.
So income taxes are maybe 25% of the taxes collected, GST is 50% of the taxes collected. So GST is not even in the hands of the budget anymore.
Right.
So I would say that would go a longer way in encouraging spending.
Okay. Deepa, in the context of markets, how do you see this possible tax cut affecting the markets?
So markets basically I think is very, very buoyant, and I would love to see that it remains buoyant, because I think a lot of whether it is SME IPOs, whether in many other segments that we didn't see retail investor coming up and spending so much of their saved income into it, they are coming up into that segment now. So I believe that this entire, I would say bohemia around the Indian markets is going to continue, given that we are also included in the JP Morgan index. There's a lot of foreign money as in coming in. So I guess it's a very good interplay between the domestic and the foreign money coming in and being there. I would say if at all the taxes are going to help, if it is done in a very, very balanced manner. I am looking forward to a lot of...
That's good to hear.
Yeah.
Yeah. Ajay, are we looking at a tax cut at all? And then I'll ask the second question second.
Yeah, I don't think so. And again, we must put it in perspective. Deepak had put, he remains one of my favorite people in terms of ideas. He had put a nice schematic that the total salaried people earn about 29 lakh crores and total corporate earnings are about 20 lakh crores. And if you see the tax paid by salaried people, it's more than the corporate tax.
It's 19 and 17.
Yeah.
Yeah.
Very nice schematic he had put. And if you see taxpayers out of the total, 7.4 crore returns are filed. Hardly 1.7% Indians, which is like about 1.4 crores Indians, are actually paying income tax. So 6 crores file returns but don't pay any tax. So 1.4 crores, 1.7% Indians are paying 27%, 28% of the government revenues. It's a very lopsided structure. And then if you look at India that way, this is Nilesha's favorite schematic. I don't know if he spoke about it with you, but 1% India is French. Then you are Indonesian, 20 odd percent. Then you have got Kenya, and 50% is sub-Saharan Africa. You have to take care of that sub-Saharan Africa. All of us sitting here are the 1% who are French. So you have 3 Switzerland sitting in India. You've got 5 Denmarks. You've got some 6 Norways. That's why you see so much consumption. But then you aggregate it. What the first point you made was the main point. 4% personal consumption growth in an economy which is 60% GDP is driven by consumption. You have a 4% growth. How will you do 8%?
What do you attribute it to? So that's the puzzle, that what has happened to consumption growth? What happened?
No, the 1% is consuming.
Right.
The 20% is able to consume.
So we are saying
it's
rest, a K-shaped growth. Then,
yes.
I mean, it is.
Yes.
We are agreeing with the fact that K-shaped growth really means that the affluent part of the population is doing better, and the people who have not been that well off are actually doing worse.
Yes, it is. Okay. And you are not able to create jobs. What we were discussing earlier today, entire PLI, 1 lakh crore investments, Deepak, came in, 8.1 lakh crores is the sales, 40% is exports. So they're making huge money. 8 lakh jobs were created total. On a sale of 8.1 lakh crores, you could create. So it is not going to happen that you will do a China. When China came into WTO, there was no China. Now India to do China plus 1, China is sitting there, Vietnam is sitting there, Bangladesh is sitting there, Mexico is sitting there, which will, even they're stamping the steel. So much so US is now saying, Chinese steel coming via Mexico, I am going to put tariffs on that. So today you can't do a China plus 1 because there is a China sitting with excess capacity.
Absolutely.
And you will, so that 50% sub-Saharan Africa, first you have to legislate for them. We come very late, the 1% shouldn't even open their mouth. We are getting whatever we are getting, we are getting. That 20%, I don't think they'll get any relief. The bureaucrats don't want to do that. And end of the day, it is the technocrats, the bureaucrats who are running the place. You have to see the 1% don't matter in the votes. Above 1 crore, you're paying 42% tax. It's aggressive. There's a Laffer's curve that works. Even a country like Russia, when Putin first came in, Monika, he cut down tax to 13%, their revenues just shot up. Now he's coming back, he's putting, but guess what? How much is he saying? 22%. And there's a big hullabaloo about that for 22% to the oligarchs. Here you're paying 42, 43% tax. So the guys try to hide. Everybody corporatizes. Every actor today is a corporation running. You can't, the salaried guys who can't set up corporations are the ones paying the regressive
So there is
tax.
this narrative that middle class is really hurting, and middle class has been a large vote base of the current government. So you don't think there'll be anything, let me just keep talking to you. You don't think this middle class who's hurting, last few years there was no fiscal space. This year we have the fiscal space because of RBI's transfer of that money. There is, and also consolidating balance sheets, a higher tax collection. So basically there is room for the government to do something. You don't think they will do that?
See, in a democracy, you also have to get elected back. That's always the big
Elections
risk.
are 5 years later.
There are state elections, there are various other things. So in a very ideal situation, if you and I were deciding and what's good for the country, I would say try and balance the budget and don't add more. There are a lot of studies which show that 1% of the fiscal deficit increase means about 25-30 basis point increase in the government borrowing cost. And government, what Deepak mentioned earlier, government borrows, it squeezes out the private, it squeezes out the retail. So if you are paying 10-12% on your personal loans, or the developer is not getting his lines re-sanctioned below 14%, it comes back to that fiscal deficit. We forget that basic economics because everybody is kicking the can down the road. So I don't think you will come below 5 at the most, despite RBI giving.
That is the deficit number.
And what you forget, when we go and pile on to the rating agencies that India is doing so well and still you put us at the last rating of investment grade, they said, what about the state
deficits?
What about off-balance sheet?
Correct.
That Chidambaram was a master in it. You had bulging carpets. At least they have brought everything
To
largely.
the credit of this government, I think the finance minister deserves credit. During the whole COVID episode, she brought the off-balance sheet items on board. The states are a different problem. But I'm going to pick up on this deficit story and then talk to you that we know that we have a good fiscal story this time. The expectation is that the borrowing number is not going to, it's going to be in line with the expectation of the vote on account. So walk us through on what that means for the bond market. You're the bond market guru.
There are no gurus in markets, but only learners. But I think here's at least my take on this. RBI's dividend is not a one-time thing. At least for now, it will be because they have $600 billion that was earning almost 0% earlier. Now, even in the West, you're earning 5%. So with that 0% earning, they were able to give 50 to 60,000 crores a year to the government. And given that they have maxed their buffers, they can only hold a certain amount of money as buffer. The extra earning that's coming from the deployment of that $600 billion, even at 3 or 4%, is about 18 to 20, $25 billion. That's about 150,000 crores of revenue that would otherwise have not, they would have not got about 2 or 3 years back. Given that interest rates in the West is likely to be around these levels for the next 1 or 2 years, I think this is going to be a continual dividend. So the government should not look at this as one time only. That gives them the ability to plan something for the next 3 years, even if it, because it gives them fiscal space for 3 years. Additionally, what we did, and we'll release this soon, we found that the government ownership in even the public sector banks, because of the consolidation, it's way above 75%. If they were just to bring it back to 75%, in many cases, they would have reap benefits of more than a lakh crores on effectively what would be disinvestment in the coming years. Given this fiscal room, I think the bond markets will appreciate this, not just from Indian perspective, because now you have foreign investors in Indian bonds through either the bond indexes or through the FAR route that the RBI has created. This should create a lot more space for non-government credit to take shape, because I don't think the borrowing program will come down necessarily, because honestly, if you give the government money, it will find ways to spend it. But I also think that because the deficit is not at risk through this excess spending, if you may, the bond market might not take it meaningfully badly. I'm not saying that it will take it well. You're already at a situation where your short-term, say 1 year government debt is trading at roughly the same rate as the 10-year, and perhaps even a little more than the 10-year, because the market expects interest rates to come down, because whatever's happened so far has actually contained inflation in a way that the West is almost admiring in India comparatively.
Correct. We've done pretty well. So Deepa, I want to just bring this point forward a little bit, that there are 2 triggers for the bond market now. One is this government borrowing program, and whatever, at least I have seen of the FM's budgets, it's been conservative, it's been towards consolidation. I would imagine that she would not splurge when she doesn't need to. Being a woman, I think she's very prudent. So that's a plus for us in the country. And the other is that we are at the top of the interest rate cycle.
Yeah.
So there are 2 parallel things coming at the bond market. How do you see that playing out?
If I can see it from this angle, that the bond markets are otherwise as well being given certain impetus by the government, or the rules and regulations that are coming up. You would see that there is a 25% that you have to necessarily borrow from the bonds, right? So the route itself is getting preferred. So I guess this is going to further see that the interplay is further going to see, while rules, regulations and other things become better for the bond markets, this again will play a very large role.
Okay, so it's positive.
It is
for
positive.
the market.
Yes, it is definitely going to be positive for the bond markets.
Ajay, twin and actually 3, the inclusion of India in the JP Morgan, top of the interest rate cycle, budget consolidation, fiscal space. I would imagine that great time to buy bond bond funds, for example. I mean, this is not a recommendation in any way, but just in terms of market triggers, and this is not meant to be investment advice, but we're looking at the markets, we're looking at the cues, we're looking at the interest rate cycle and the other evidence which we have in the market.
No, it's a good time to buy, but only thing is you're not being rewarded if you want to buy a 10 or 30-year paper. It's priced very near to the 1-year paper, what Deepak mentioned. So I have been a long duration for very long. I expected rate cuts by now, and I would have made capital gains. I was waiting for that. It will happen 6 months, 1 year down the line, it will happen. So fixed income has a role to play in any portfolio. It gives a lot of stability. It gives visibility, so we should do that, and these are good times to lock in. So these are good yields. So for your fixed income portfolios, it's a good, and for Government of India risk, you're paying, getting paid 7%, plus the fund manager will add on a 0.5% by trading. So you're getting good yields on even gilt funds. They've done well, they'll do better. So that's a good option. But coming back to the Indian position, I think we are well positioned as an emerging superpower. We are number 5, will be number 3 in another couple of years. If not this year itself, given the way the yen is depreciating, so dollar terms, constant dollar terms, will probably overtake Japan. They peaked at 5 trillion 2 years back. As the yen fell, they came down to 4.2. Again, the yen is down. And their strategy is to bring the yen down because it's kick-started their economy. So next week they will raise rates a bit, but it won't rise to the Indian level. So we have a good chance of being number 3 within the next 2 years. We'll overtake Germany and Japan. So you got a top 3 country, a very liquid market, which always pays its debts, well-run country, political stability, continuity, whichever spectrum, whichever government, whichever coalition, the basics are there, and you got a demographics which are in favor of this country. So I think a lot going for us on that fixed income.
So this was the bond market part.
I was adding one point. So we were doing some interesting analysis because of the Q1 budgets getting over in our company as well. So if you look at the numbers, almost last quarter, this same year, there were around 206 crores of bonds in the market, which got reduced by, I think, around 86,000, a drop of around 34%. But when we look at the Q2 and the way the issuances are lined up, we can see certain reflection of the budget on there. So this seems to be a good quarter for us. At least that's the aim right now. So hopefully what we are all talking about will transfer into something for the bond markets.
Okay. So just one small comment on the impact of India in the index, JP Morgan index. If you could just very briefly tell us what has happened, because there is this whole anticipation that things will change, some new dawn will happen. Nothing really happened, right?
Well, actually, it has happened. I'll come to that. But first, let me explain what I think the inclusion is. See, a few years back, India had limits on how much foreign investors could buy, to the extent that every month or so, there would be an auction saying, allow me as a foreigner to please buy your bonds. So that it's literally like, I want to pay you money to allow you to lend you money. So in the reverse processing fee, if you may, the lender gets to charge, the borrower gets to charge. So it was like that for a long time. In 2018 or 19, I think they said, well, we can't do this because foreign bond indexes will not add our bonds if we have these limits, and we don't want to anyway open out from a capital account perspective. RBI went somewhere in the middle and said, let's do this in a phased manner. Let's create something called the fully accessible route, FAR bonds, which have now reached a point where you have enough of the FAR bonds where there are no limits. And earlier there were limits on, you have to buy minimum 3 years to maturity. If you buy less, then you have to have a certain percentage. And so none of those rules apply. So because of that, you're able to get into JP Morgan indexes. And therefore, they've said, listen, and remember, this is the Indian government borrowing in rupees, not in dollars. So if a foreigner buys our bonds, they're taking the India rupee to dollar risk on their books, which is great because we earn in rupees. Why should we pay in dollars? We are effectively allowing Indian rupee debt to be bought by outsiders. This is American philosophy. America does not have reserves. America just gives out its dollars, everybody else buys the
Buys
dollars,
them.
and the people are able to spend because the government does not have to borrow from the local economy, they borrow from all over the world. We should inculcate more of this. But what we think has not really happened has probably happened in a much slower way. 85,000 crores have already come in into the debt markets in calendar year 2024. And even in June and May, we saw a significant influx of dollars coming in. So much of this must have been in anticipation of the JP Morgan index additions. And they're also not adding us in such a sudden way that it would disruptively change
Right,
prices.
right.
So it's a slow addition over time, which allows, I think, India to actually plan out that, listen, even if we issued all these bonds, there is demand. So at one level, supply is contracting because the government doesn't need more money, but demand is expanding
Right.
because you have more people
Right.
looking for it. So
Okay.
it will be an interesting outplay of prices
to see
over the
where
next.
this goes. Okay, so it's good to hear that there is good stuff in store for the bond market. But let's turn to equity markets, and maybe I can start with you, Deepak. There's been a whole lot of interest in the last few years in the equity market, especially with the millennials and Gen Z. We have also seen that the future growth of the market is somewhere dependent on consumption rising, private investment growing, and that leading to more economic growth. Now, unless the private investment and consumption story is sorted, do you think equity markets are in trouble? So there is a budget input which can happen, but there is a larger macro story playing out. How would you decode it in this context?
So this has been interesting because when you say domestic consumption, usually or consumption, we usually equated it to the FMCG players, which have already been significantly overvalued in the last few years. So they don't see any significant returns. And plus, I keep saying, how much more toothpaste will you sell? You know, at some level, you're going to have that problem. But there is a lot more premiumization happening in everything else. We've seen it in coffee. We used to pay 10 rupees for a coffee. Now we have no problems paying 400 rupees for probably what is worse coffee, but still it's you're paying
branded.
for the branded, and you got the ambience and all that. I think the premiumization has not really trickled down all over. So it still excludes a lot of people for whom it's just out of reach. And the mid-premium segment, so there's 10 rupees and there's 100, 400 rupees, but is there a 50, is there a 75? Those areas. India doesn't have a biryani brand. It's our favorite food. It doesn't have a masala dosa brand. It's probably the most famous South Indian thing out there. And yet, these brands are still coming. You're seeing an MTR starting to grow. You're seeing a Haldiram starting to grow. Saravana Bhavan going all over. So I think these brands are just coming up. And perhaps in the next few years, we're going to see a lot more of that happening, which I think will drive a lot more of the consumption going forward. But to be fair, the last few years have also been a rally pushed through by government incentives, like PLI, for instance, or changing supply to where there was no supply. India has always been supply constrained. Trains, for instance, you don't have enough train tickets simply because there is no, there's not enough trains. So when you build a dedicated freight corridor from Bombay to Delhi, you create more room for passenger trains because they were sharing the lines with the freight trains. So when you double the number of passenger trains, you create supply where there was none. And this helps the railway industry. And today the beneficiaries are the railway companies, some of them PSUs. Defense, India had a rule that we would not make defense goods because we would only import them. The defense ministry would not borrow from, take contracts from local companies, but they've switched it to they will only take for about 200, 250 items. So you created supply where there was none, and that's where the companies that are benefiting and are growing really big. I think going forward, there will be a mix of both this premiumization and semi-premiumization, if you may, moving away from the iron ore companies to people whose brands you actually
more
use.
value add,
yes.
essentially.
So some of the largest companies earlier were selling crude oil, or crude oil based refined products which you weren't using. The same companies are now selling you phones and selling you telecom connections and selling you retail products, the names you recognize. So
Correct.
I think that part is also starting to move.
That part is also happening. Ajay, Deepak has mentioned something very interesting, that there was a supply constrained economy. The capital expenditure by the government over the last few years and the incentives to corporations, the supply side has been expanded. We are waiting for consumption to take root and to grow. Do you think that there'll be something in this budget for consumption? First, do you agree with this premise? Supply side has largely got sorted. The twin balance sheet problem is over. We've got our macro story together. Foreign exchange reserves are looking good. The house is in order. Now we are waiting for the children to play. Will they play?
It will. So theoretically, what happens, the multiplier on your infrastructure is 6 to 7 times.
Oh, it is that much?
Yeah, the bank money, the money multiplier in the economy is 4.5. So you put 1 rupee in the bank, it will revolve 4.5 times in the year. So that's why banking is good, financialization is good, formalization is good, because it brings the money in. The biggest pool lying today is the $2 trillion we have in jewelry lying in our lockers. If we could get that monetized and formalized, and
so that
imagine.
I will encourage the women to keep their jewelry till you start investing in financial assets. Please keep your jewelry. That's something you have.
Yeah, you
Sorry.
have that. Yeah, true. So, in a framework sense, if you look at the whole economy, there are four pillars to the economy. There's private consumption, which is doing very badly, 4%, because your agriculture is growing 1 to 3%, and 60% of the population sits on agriculture. 45% of your workforce is agriculture, which makes value added of 18% total. So there is no surplus there for a huge tail. That's why I said 50% sub-Saharan Africa levels. Those are not $2,000 per capita. We are the ones who raise that amount up. So one is private consumption. Second is government capex, which is doing phenomenally well. About 60-70 lakh crores spent, and that multiplier is now kicking in. So remember that 10 lakh crores which came in 5 years back is now going to contribute 50-60 lakh crores on a sustainable basis to your GDP. On that, you add on a 12% tax to GDP, that's your revenue which is coming in. So they got that mantra right, which was very good. Third is private capex, which really stalled from 2012, and it has not really come back. That gross capital formation is not of the Chinese level of the 2000s, which was needed. So third pillar not there. Exports is the fourth, where we are doing well on two things, services and invisibles, the software and the services. The goods we have stalled. There was one fillip which took us 30-40 billion, it helped us, and then we have stalled. So goods, we are not able to come into more than that 2% of the goods. So those are the four pillars. You can pick your choice, and every company that is listed fits into one of the pillars. Then you have to figure out what is there. Like he said, the QSRs and also all those Indian, you thought these are making savories, and mithai walas are getting billions of dollars of valuation.
All the big names of the corner store is now, yeah.
So you're just wondering that should we have become halwais or not done MBAs and CAs? Maybe that was a better...
finance is boring, doesn't make money, boring. Let's sell samosas.
Kept giving advice to people, but didn't start a mithai shop or a halwai shop. So overall, within the four framework, I think the biggest problem for the government is we have tried the trickle-down theory that you just create a lot of money at the top and that will trickle down. It's not happened. You have tried redistributive justice, which has worked. Targeted subsidies have worked. Now what is needed is either you just go bonkers with a 10-12% fiscal deficit and put money in everybody's pockets. You can't do that. Second thing is some smart spending, like what I would do. The ATC, for example, I will say anybody who buys a TV or an AC or a fridge or a two-wheeler this year can claim that as ATC, because that multiplier is much more. It boosts the consumption. Anybody hiring a maid, which we all do, the Scandinavians have this model. Sweden and Norway do this. If you have a house help, you have a driver, you're creating a job, you can claim it as a tax reduction. So make ATC as your maid allowance and as your driver allowance. Let people hire, because that is money going in
somebody's house.
And the government
That's very interesting.
Is never so efficient as a private person is efficient. Of course, there'll be ghost maids, ghost drivers. Okay, 20%, 30% chori hoga. 70% will lead to such an upsurge that this year, buy a TV, buy a washing machine, buy this. I will give you ATC as that. No ATC in finance.
Right.
Those are some of the things
very
we
interesting.
have to...
Yeah. Deepa, do you agree? Because this idea is doing two things.
Yeah, absolutely.
It's boosting consumption and it's boosting markets, both.
Absolutely. So, again, you said the woman mentality in the entire thing. Let me bring that. So, this is more about macro that we have heard. If you look at the micro economies, you see these local communities are supporting each other. The spend, the income, and the entire consumption is happening in that community. So there is, and also it is shifting. So, like for example, the maybe 20% of my income is going into the driver's salary, the maid's salary, and many other things that we are spending. The spend on education, where again, who is teaching your child, is another spend that we are looking at. And we also see this flight of money from here to tier 2 cities. In tier 2 and smaller cities, the consumption has increased multifold. In fact, most of the consumption is happening there. They are moving out from a smaller house to a good pakka house, and they are spending into other things, which clothes, you can think of anything. And apart from FMCG, I think there is a lot more consumption happening across segment. The way you buy your vegetables, the way you spend on many other things which you are not spending, means that your ability to get into that tax bracket, or how these are converging into that tax paying customers, is something which is growing, that's burgeoning right now. So, and if you see the other side of the investment, almost 60%, that is including real estate and gold, that is the consumption pattern we traditionally had, and that has been our investment model. The spending model has been again slightly savings bent of mind, but the spending has been purely on requirement basis, which now if you see the retail investors, the retail consumption that's happening, it has really spiked up. So all this, including the macro statistics that we are talking about, definitely we can't ignore the lower income groups, the groups which are really migrating to the middle income groups. So your focus on middle class has to be there.
Has to be there.
And that is what is going to give us not only the political stability, but also a lot more in terms of economic stabilization.
Right. So what I'm hearing is that they need innovative ideas to boost consumption. A simple tax cut may not do it, because very few people actually are in that bracket, but something which boosts consumption overall. But I want to come to something, and maybe Deepak, you can start on this. The budgets are not places to do regulatory cleanups, but there are a lot of instances where announcements are made. What are some of these issues that markets face because of inter-regulator issues that a budget announcement could fix? So it's not directly related to the budget, but because the budget statement is seen as a policy statement, you have that elbow room of using it. So any inter-regulator issues, because India has so many. You have RBI, SEBI, IRDA, PFRDA.
And now there is also this global finance for IFSCA in the gift city, and then there's a financial sector regulator which is being talked about. Different set of rules for retail companies. They're talking about a telecom. The telecom has a different regulator. But I think yes, the interplay of regulators is important, because sometimes a simple thing in the financial industry which we face, I think all of us face, is the dreaded 3-letter word KYC.
KYC.
So if because KYC means 100 different things based on, forget which regulator, but which type of regulated entity you are. A bank is regulated different from a NBFC, and a mutual fund is different. I mean, the KYC requirement for a mutual fund, and sometimes it's almost contradictory, because sometimes the same regulator will have more rules for a less regulated player than a higher regulated player, and so on. So these rules need some kind of intervention, perhaps at the policy level at the government, that says we need to unify. We did this with UPI. Banks could create their own payment systems, but then the government said we'll do this overarching method. But of course, the method came through RBI and through a bunch of things around NPCI and so on. But I think here we do need to create room for removing some of the arbitrariness in regulation that unfortunately has creeped in, because there has been no opposition to the arbitrariness. It is it's unavoidable, because if you give somebody power, they will use it sometimes in the best intentions, but the best intentions of one regulator may not be the best intentions for the economy as a whole. So you need direction that says these are levels which you cannot cross, and these things need to be defined in better words. I would say that was one. Of course, I think within regulators also, I would say encourage a lot more openness. I mean, there are simple things like, for instance, the RBI has unclaimed deposits of I think now 80 or 90,000 crores, and there is. It's incredible that they've set up so many systems to try and find the people that have done it, and yet there is no response. Can you find a more meaningful use? The government could borrow it. I mean, in a certain way that provides interest to these people when they come in. These are things that I think maybe have to be thought about
at a policy level. Ajay, anything that the budget can sort, especially in terms of, say, things like KYC, any other ideas?
All this will be extra budgetary, so I don't think she'll go down to KYC and stuff, but it's a crying need. Regulators need to sit, and just like Aadhaar, we have, you and I should be a KYC approved person.
But we have to do it over and over again.
And
for ridiculous things. I was basically updating my father's health insurance policy. He's 88. He has had the policy for 40 years. They needed a KYC to redo the policy one more time. Like, why do you need a KYC?
And all are asking you for Aadhaar. Supreme Court says you should not be forced, but try not giving your Aadhaar. So everybody has your Aadhaar. When you go to check on that Aadhaar, there are 530 phone connections on your Aadhaar in Jamtara. And your Aadhaar and PAN is used for 200 accounts. RBI governor says there are mule accounts. You don't even know. Some mule account is sitting in Mewat in your name because your Aadhaar is with every roadside vendor. Your PAN, Aadhaar, your phone.
It's everything.
And, my friend got an interesting call in Bangalore day before with his son's name. And that WhatsApp call comes with the police guy's photo in it. And he says, I've arrested your son, the normal CBI scam. So luckily his son is in Hyderabad, he could, and the number was +92. So he realized it's a Pakistani number. But my friend is the 1%, he could understand it. He's a Wipro retired technology buff, he could understand, and he tracked the guy, he got into his system in fact, and took over his laptop. But how many of us do that? So do the KYC, at least give us, and don't have my Aadhaar and PAN floating around with every single vendor. I'll give you a small example. You try putting money in a mutual fund right now. Half the mutual funds are sending the money back after 3 days. Either your nominee was not there, or your KYC was not there, or your mother's KYC was not there, who was a joint holder in one of your 45 mutual fund folios, because they have not put everything together. Or US 64 you had in 99. So I am bouncing your this. So, that is the real harassment that people, there is no ease of doing mutual fund or ease of doing banking that's there.
Deepa, any ideas?
Yeah, I have an interesting, conversation that I had with the erstwhile governor of RBI. He happened to sit, in the seat besides me, and I said, I think I know you, and then he said, yes, I am the RBI governor at that point of time. So what we were discussing at that point of time, we were trying to establish the TREDS model, which is the MSME receivable financing discounting model. The interesting part was that why do you need a documentation? Physical documentation is not required. Literally, what is physical documentation? Primary part is the KYC, etc. Right? So when you look at, and he said, even I don't know why it is required, because everything is there, it is just duplicacy. So today in the interregulatory forum, the one which Deepak talked about, is that the whole idea is there is a DLT platform. All of us, including RBI, SEBI and all the regulators, can go and look at that blockchain and say that we can bring data from here and disseminate in a uniform manner, or we will at least use it, right? Similarly, we did FATF global evaluation happened, and the industry represented there. Everybody together is struggling on KYC. So the meaning is that we should try and have KYC as a very standard format where accessibility is the main problem. It is not about, transparency or saying that I don't want to give it. We will happily give our KYC. The whole issue is that how do you use it, and is the inter-regulatory forums are using it in the right manner? That can solve for a lot of issues.
Right. So for KYC, I think they need to do a UPI.
Absolutely.
Or
It
an
has to
Aadhaar.
be. Yeah.
What we did there in terms of technology and consolidation, they need to do that for KYC. I think
Look at your
KYC
digital-
harassment is
yeah.
one of the top
Yeah.
issues right now
Yeah.
between regulators, with the government. And they should use the platform of the budget to announce, we will sort it out. We have the technology, it's just a question of will now.
Yeah.
Okay, I want to move to real estate. We've done bonds, we've done equity, real estate. And let me start with you. It remains a difficult asset to regulate. Formalization has been very difficult. The budget year on year gives more and more SOPs to real estate. The long-term capital gains period went from 3 years to 2 years. Now, real estate in my head is a 20-year asset. So when you say from 3 years long-term capital gains is now reduced to 2 years, I'm hearing this speculators, this is for you, right? And we know that real estate remains a sump of the non-tax paid money. So stitching all of these things together, what should we expect in the budget for real estate?
Let's break it into 3 parts. First is about the low income and the affordable income group, where they do investment because they really need it.
They need to live there.
They
They're
live-
not
yeah,
flipping houses.
yeah. So there, anything which will hurt the sentiments is going to be contra for the economy, and that is something which we must protect. The next one is about who are buying houses for the first time. Now they again are maybe irrespective of the amount that they are spending. That will help them to get into that new house and probably stay. And anything beyond that, if there is a slight differentiation, then the investment class versus the actual living class will get differentiated. So that could be another way of looking at it. The third is about the fact that the entire issue of rental markets, or the rental economy that we are talking about. So most of us cannot afford. So hence, in a city like Mumbai, maybe none of us can have a house which is livable. To that extent, if the rental economy is also supported, that will give a lot of boost to the entire segment of the real estate segment. So the money that is coming in has to be less speculative, and accordingly it has to be very balanced in terms of how we treat the affordable housing segment, the first time investors, and the ones who are actually trying to speculate and invest. So that could give us a good interplay. The other thing is about the entire ease of managing things. So just bringing that blockchain back, the entire digitization of land records, that can really help. That has really harassed a lot of people. It will help both the customers, the landowners,
Right.
and the government.
Yeah, but Deepak, we've seen that transparency is not something that either the politician or the bureaucrat wants, because that's where the graft money goes in. So my problem with real estate really has been, like you were saying, Mumbai is unaffordable. Why is it unaffordable? Because of the huge cash segment. So still property deals are being done by what, 40-50% cash. You remove that, you get affordability right now. And I call this the cost of corruption, the cash amount. Again, in terms of keeping budget in mind, what are the right signals to be given through the budget for real estate?
I'll give you 2 things. Firstly, I think real estate, we've already given a lot of SOPs.
Correct.
To be fair.
In terms of even rebalancing,
Correct.
you're allowed to buy a new house out
correct.
of your capital gains. If you make profits in equity, you can reinvest in a house and
in 2 houses,
in
not
2
just the
houses.
houses. So
Right.
it's like they no longer care that you live in it.
Yeah.
You can actually buy another house and rent
That's
it
right.
out, and they want
Yeah.
to encourage that. You get the lowest cost loans for housing. You're able to take principal repayments for housing out of your ETC
Correct.
limits.
So huge number of
interest
SOPs.
payments. Yeah, you don't get this for business. You don't get this to run a business. I mean, to run a business, you get some expenses out, but then this is not at a personal level in terms of lowest cost loans and so on. So I don't think they should encourage that. One thing they could do, for instance, is to change the market from ease of access perspective. So in Bangalore, for instance, the way you talk about in Bombay, a lot of Bangalore apartments are entirely just in check or in white. So it's almost become a necessity that they are, because mostly people are in the tech sector where there's not that much involved and so on. So there is an element that you could maybe India could learn from Bangalore in that sense, that
Right. How to do
corporatize
this.
in the
Right.
sense in some ways it is still doesn't make it affordable because supply is still lacking.
Yeah,
We
so
need to increase
it's
supply.
a supply side. What they've done on infrastructure, they need to do in real estate for
So
supply.
Hyderabad did this, and Hyderabad is a city which is people in Andhra Pradesh and Telangana, they love real estate, but real estate prices in Hyderabad didn't go up because he built roads so well that you could be 40 kilometers away and you could still reach the center of the city in 40 minutes. If you can do that, there's unending supply, so the rate increases are relatively controlled. It's gone down in recent times, but now you might have something crop up again. But I think also that NRI access to this market has also been, do you know that NRIs when they sell, they have to pay 20% tax on TDS on that. So they have to apply
because of the runaway NRIs. They would sell and not pay. So
tax.
Now you have to pay.
So, but you have to pay the 20% on the selling price.
Correct.
Not the difference between your buying and the selling price. But you have to, then you have to plead with the government saying, let us deduct a lower TDS. So I think this aspect of cleaning things up can actually,
Last thoughts on some innovative ideas for real estate, because there is a problem.
There is a problem and it won't get solved because, for example, in Maharashtra, since independence, the chief minister always holds the urban development portfolio. So it funds the political parties. That's the reality. Why you have to stay on one island? If you had built 5 bridges into the mainland, you would have never needed
immediately
this kind of price.
Part of the supply problem. Yeah. Okay, so it remains a political problem.
It's a myth. I mean, I had a very old person I used to work with. He started working in the bank at 18 years and I met him when he was 70. After retirement, again he had come. He would always say, emerging market capital, commercial capital, never buy real estate, always too expensive, overvalued. I bought the biggest expenditure of my life, 2008, is up 40% today after 16 years. I would have made it 6 times in the market probably. By that time, Sensex was 21,000. It's 80 today.
Right. So this has been a great discussion. We are out of time. And it's sounding as if it's largely positive. Ground is largely laid for good gains to be made in terms of growth for both equity and bond markets. Real estate remains mired in trouble. So I want to thank you all very much for being here.
Just one point, if I can, not to make the last point, but I think the momentum of India is such that in spite of any policy, we'll do well.
That's good to hear.
I will not say that it's yes, a good continuity, good stability helps all of us, but it's the Indian momentum, and that has come. That is very much there.
That's right. This was a fantastic discussion. So things are looking good. There are, of course, some clouds on the horizon, but overall, we seem to be in a good place. Thank you for watching, and we'll be back with more.